So hi guys, welcome to another episode of Bets and Balance Sheets. Today the episode is about mergers and acquisitions in the gambling industry, analyzing financial strategies and outcomes of these deals. We're going to discuss the recent M&A deals in the industry and how consolidation impacts the competitive landscape in the market share. With us we have Robert today, partner at KPMG, experienced in the M&A industry within gambling. And on the other side we have Paulo Andrade, which is delivery manager at Aurum Solutions, ex-PwC and Deloitte, with experience in M&A but outside the gambling industry. So we can have both perspectives here within this space. And to start this podcast, I want to go into the complete opposite direction and start asking Bob, how can an operator increase their offerings without actually merging with another operator?
Sure. So great question. And we've seen this a lot through product development, I think, with a number of operators. In the U.S. market, the player experience has become increasingly important, especially from the early days post-PASPA, where we saw a lot of players kind of jumping around following incentives, following free promos, things like that. We are seeing a bit more loyalty amongst the player base now. And a lot of it is building out the better experience for your operators, for your players. And so I think some of the operators that have been really successful in doing that have developed their loyalty programs in a bit more robust manner. Starting to see more engagement within the NFT marketplace, particularly with deals that have been signed with leagues and conferences. And so without M&A, I think there's a big push to develop the experience better. One other area we are seeing is also leveraging a lot of very high-performing white label providers to help enhance your product as well. So I think those are some of the trends we're seeing out in the market right now.
Do you think those trends justify the amount of money that these operators are spending to merge and acquire other operators?
I think that's probably a question for the analysts to really focus on. We've seen a lot of very robust discussion on some of the deals in the space that we've seen. Heavy publicity around the two most recent acquisitions this summer that were announced. We will continue to see a lot of spend in the U.S. market. I think both from an M&A front as the market heats back up, which we expect it to do, but also from if you quote the land grab for customer base. There's still a lot of states that are not legalized. Some of our largest states like California, Texas, and Florida. Florida looks like it'll launch pretty soon now with the most recent appeal being rejected. So I think you will continue to see some level of spend, but on that trend, we have seen the investors have a much more dim view of that. So it has to be a little bit more of a responsible spending approach.
Okay. What do you think would justify their spending approach? Do you think they to get this market share and to grow this fast, they wouldn't be able to do it without the acquisitions? Or it would be more expensive to do it?
So I think some of what's driving the acquisitions that we've seen in more recent months is both I think kind of two parties that are willing to go into this space together, or willing buyer, willing seller in one case. And you have seen with the interest rates and some of the market pressures, you have seen a little bit of a downward pressure on valuations. And so while I think people are spending money, I think they're being a little more thoughtful about it. The one deal that was announced this summer, if you rewind 12 months, the asking price for those assets was significantly higher than what was ultimately agreed to, even with a late bidder coming in towards the end and driving up the purchase price. The more recent one, which is more of a licensing deal, that's a heavy spend over time. But if you look at what some of the analysts have been speculating on the return on the net present value, is there's a pretty good story to be had there if that's done and rolled out and integrated in a proper way. Then the spend may well be justified.
Mm-hmm. Okay. And Paulo, how do you think that's like compares with other industries? I think like Bob mentioned one thing that is super interesting, which is the licensing part. And we, for example, see a lot of fintechs that are acquiring other fintechs within different spaces or even in the same country to get access to certain licenses that they own. But even apart from fintech, how do you compare this to others?
I think definitely the reasons and motivations for the M&A are quite the same. So you obviously want to maximize value for your shareholders, so that can go in a way that's inorganic. So I guess that way you can expand your growth, expand your geography, the markets where you operate, consolidate share. And I guess the difference is it comes when you start drilling down to the specifics. So obviously, gambling is a heavily regulated industry, so it's by far, I would say, one of the industries that is most regulated. You can see that underage gambling, responsive gambling, fraud, money laundering, obviously the licensing part as well. So it encourages an operator to buy a company or acquire a company because the licensing part can take loads of time to get, so it's not easy. Even the player databases, obviously, you can acquire and you can expand your customer reach easily by kind of buying a portfolio of customers, which is much better than kind of starting that on your own. And how does that compare to other sectors? So I guess, for instance, if you look at healthcare, if you look at the things you analyze over the deal, for instance, in healthcare, if you look at, let's say, blood X-rays or blood testing clinics, so you could look at, so the impacts would be the key personalities there, the doctors, so the people that those docs that go to those clinics actually because of those doctors. You can look at, for instance, the fixed assets, is if the machinery or not is old or not. So in the end, you will buy that clinic for a price. You need to make sure that whatever is there, you don't need to invest more in facilities. The same with manufacturing. I guess it's not let's say a virtual business like the iGaming. So you need to kind of look at different things. You need to look at contracts with suppliers, with customers. You need to make sure that your revenue or the people where you buy your raw material from is not concentrated. So yes, I guess it's just there is different things. So the outcome would be the same, obviously, but you need to look at different things in different industries, and I guess they're quite different in terms of like in iGaming. And iGaming is quite specific, I would say. And let's say manufacturing technology. So if you look at the SaaS business, for instance, you look at the ARR, you look at the customer churn, the technology that you have. I mean, what sets you apart from other competitors, which is a bit different from what you see, and I guess in iGaming.
Okay. And do you think that I don't know if you have experience in the landing base as well, but do you think these concerns would also transport to landing base acquisitions?
I think in general they do. I think what's a little bit unique when you compare, iGaming and sports betting acquisitions to land-based is, there's definitely different motivations for doing those transactions. One of the trends we've seen in land-based, right, is really monetizing the real property assets. And so you've seen large players purchasing the real estate. Well, so in the transactions, there'll be a bifurcation of the assets, and you'll see, kind of a real estate investment trust in the U.S. is often the buyer for the land and the buildings, and an operator will be the buyer for the actual casino operations. And so the motivations there, I think, are a little bit different, but many of the same trends. You still have to look at the underlying fundamentals of the business to make sure it's a viable transaction for everybody involved. So,
do you think it is equally good for both sides of the deal, or do you think there's always one side that is going to actually earn more from it than the other one?
I think it really depends on the deal and the assets that are involved here. I think the results that you've seen in the market on land-based, where you have the real estate investor that's buying the assets, and then you have the operator that's buying the casino operations themselves. There has been a compelling story for that being successful. Often the operators are really, really good at exceptional, really, at running a casino business, but perhaps not as good at monetizing the value of the real property. And so I think with the split transactions, you can see that value maximized in some cases for both buyers.
Do you think companies outside the gambling industry operate with the same principles when they do M&A? And
well, I think most of the times the interest should be aligned, or the strategic vision. So I guess definitely both sides normally need to have their best interests aligned. So I think that's something that happens. I guess, yeah, in terms of the other industries, I would say that if you look at, obviously, 5 years ago, before you have two different financial landscapes. You have pre-COVID, you have after COVID. So you can see that, I would say, pre-COVID, you would have the technology, healthcare, financial services, energy booming. I guess after COVID, you could see that, for instance, technology companies, let's say like Google, Microsoft, in the beginning, I would say that they will probably invest more in their own technology and try to spot the next technology or the next trend. I guess now, even with COVID, you have more fintechs, you have more startups developing more AI, machine learning technology. And I guess for a company like Google or Microsoft, you prefer to try to spot where the golden goose is, and to actually, if you invest in a lot of these companies, you just need to spot one. I mean, and you'll be done. I would say that in terms of healthcare, I mean, obviously you could look at the pharma business as well. With the COVID, there was a massive boom of the pharmaceutical companies because of the vaccines. You have, let's say, two sides of this. So one, that actually you need manpower to fabricate more, and then you need, I would say, more local clinics to actually expand the customer reach. So I guess there was a shift there where you started to buy much more local businesses there to expand your growth. So yeah, I would say that in principle, the reasons for the interests of both buyers and sellers should be aligned. So I kind of see that goes along with iGaming.
How do you think these people should do it? What is the process of making sure that your interests align, or how should they make sure that the deal is going to be to their best interest? Do you have any suggestions?
I mean, I just think you need to. I mean, if you're talking about best practices in actually M&A, I think first of all, obviously, as I was saying, the strategic visions needs to be aligned. I guess in the way that you should hire as well valuation experts. So there are different valuation models for different industries. So I guess having the right model for your industry and actually understand how can you monetize your unique value proposition is very important. I would say that, and probably Howard is going to like this one, you shouldn't be cheap on advisors. So I guess you should bring to the table experts on this industry that you are analyzing. So you can have, for instance, for due diligence, you can have multiple due diligence occurring at the same time. You can have financial, tax, legal, environmental, technical, and I guess the more confidence you build on those due diligence, that means that the decision on that deal happening or not under that price, you are going to be much more comfortable with that, which is good. I'd say that one thing that probably misses the common person in the sense of that doesn't know M&A that well is the fact that you should start the integration as soon as possible. I mean, I would say that the post-merger acquisition is something that people feel like when you put pen to paper to a deal probably is over, and I guess that there is also a big chunk of the work to do there. There are systems to integrate. You you before you had two CEOs, now you probably only need one. You have an executive team that you have to merge. So it's kind of I would say that those best practices, like, it's kind of like what I would probably say that should be, I would say, transversal to any industry.
Yeah, and like in iGaming, we see, for example, a lot of operators in the US starting small businesses. They can then be acquired by bigger ones. What do you think like they should care about to make sure that both of the sides have the best out of these deals?
Sure. Excuse me. So I actually agree with everything you said there on some of the key factors in driving a successful deal. I think in the U.S. and any other market really in sports betting and iGaming, a lot of this will ultimately come down to proper valuation. I think over the last few years, we have seen both a situation where valuations got a bit out of control, and quite frankly, that occurred because money was cheap. It was very inexpensive to borrow to do a deal. Valuations were pretty inflated. I think they've started to, in most industries, including gaming, have fallen a little bit back to probably a more realistic level. So the valuation piece is still very critical. Understanding what you're getting from an asset perspective, whether you're buying assets directly or you're buying the actual company, the proper diligence, and in iGaming and sports betting in particular, legal, financial, even tax diligence, extremely important. But then to your point on integration, I do think people tend to not forget, but maybe de-emphasize things like IT risk. And this is not around like cyber or AML. I think everybody's attuned to those risks in gaming, but sort of just the operational IT component. And how successful can you actually integrate systems and operations post-deal? Because the system integration thing is absolutely critical. And we have seen acquisitions in recent years that sort of have fallen apart a little bit because either somebody paid too much for the asset and they were not able to successfully integrate it, and you wind up walking away from something you paid a lot of money for. So I think it's absolutely critical, those areas, to make sure those are successful on both sides.
Yeah. What do you think are the best practices for the post-integration?
I would say that probably before the integration is be aware of the risks of the transaction. I would say that as soon as you start engaging in these due diligence activities with this target company, you should know by now whatever systems do they use, who is the key personnel there, who do you wish to maintain in the future, who do you think that needs to go. So all of that, because otherwise you can't calculate synergies, isn't it? Because the whole point of having a company merged to another is to actually economies of scale, isn't it? Is build on less people, build more on less people. So if you actually think of that, you just need to be aware of the risks and just need to be aware of the risks before you actually start all this process. So imagine Robert was talking about the systems. As a practical example, imagine two big companies. One uses financial system as SAP, and the other uses Sage. The simple fact that you need to understand how to migrate records from one company to the new company. The simple fact that you have a pool of licenses that you probably need to let's say renegotiate, that you can get a better deal. In systems, you are actually talking about massive amounts of money. So obviously in the sense of key personnel as well. So if you have an executive board of 5 people on the other side and then 5 people on the other side, you probably don't need 10. You probably can live with 7, It's just understanding which people is going to add what to the new business. And to be honest, quite frankly, at some point, there are people that just need to go out after the buyout. So I would say that doing your due diligence before the post-merger is actually is quite important, and I'll say that it saves you a lot of money and concerns in the long run.
We talk a lot about the buying part. But I think we should also mention the selling part. What do you think is driving these people to sell their businesses? For example, you start operating in a new market, and what makes it more appealing to sell than to actually grow it?
Oh, great question. And I think we've seen instances where it's not really the same answer, depending on the company. You know, I think as we all know, there's folks that have founded a company in whether it's gaming or otherwise. You know, they've ultimately created a company, taken it to a scale where their goal is to sell it, is to ultimately monetize that and maybe go on to the next thing, especially with a serial entrepreneur. Mm-hmm. You know, if it's somebody who's very passionate about a particular industry, you know, they may be ultimately growing it, looking for either a strategic exit or feel that they may be a disruptor in the industry, right? We're seeing that. We're actively seeing that now with some of the fantasy sports operators in the U.S. You know, just this past week, if you look at the daily downloads, I think the top 2 or 3 daily downloads in fantasy sports are not household, you know, sports betting names. They're much more in the emerging growth space. You know, so I think some folks have a passion for, you know, disrupting an industry. Others, I think, are looking to build something in order to ultimately find a strategic buyer or to take it public. I do think there's very different motivations depending on the seller.
Yeah. What do you think are the best suggestions that we can give to these people that are looking to sell their companies? What do you think buyers are interested in, and what sparks their interest?
I would say that from what I remember that I worked in the industry, there was at least 2 or 3 things that I found it key. One of it is prepare your financial records. You need to be sure that when the time comes, you have everything ready on time. So you know that people are going to ask questions, people are going to analyze every amount of your business. So you need to make sure that you can back it up with evidence, with information. I would say that probably even most important is understanding what is your unique value proposition. So what sets you apart from companies in the same industry? What do you have that the other companies don't have? What makes you appealing to buy in comparison to the companies that work in the same industry as you? And a third thing doesn't look that important, but I think when you start coordinating several due diligence processes, having a data room, a virtual data room, so basically a shared folder, secured, that only a few people can access, with all the information necessary, segregated by departments, let's say financial, tax, IT. It's quite important because when you are coordinating large deals, that probably means that you are coordinating 5 or 6 different teams. These different teams have different timings, and then a deal has a deadline, right? So you need to be sure that everything is in place for you to actually do your work. So having that data room, I think, is key. And I think it's something that probably is, I won't say ignored, but not most of people think of it like that. But I would say that it's quite important as well.
I'd agree. I think a lot of that comes back to being, kind of having your strategy developed as the operating company, as what is your strategy to grow the company to be an attractive target for a buyer, and also having the organization behind it that's able to go through a proper, and we often, in this case, recommend kind of an internal, like, sell side due diligence or vendor due diligence process to kind of take you through that cycle, especially if you've not been through it before, can be very valuable going into a transaction, particularly one with multiple buyers that may be involved.
Yeah, and I'll say that I guess you can see a lot of difference of the, let's say, sophistication of information when, for instance, if you have a private equity included, so that they have a stake in a company that's going to be acquired by a major player, you can see that the data, so the questions that you are going to ask as a bidder, on the other side, they already thought of that. So they already know more or less what are you going to ask. So they kind of have an answer or have something to give you to say, look, I knew that you're going to ask this. This is for you to see. It's quite different. You see a difference and a different pace, I guess, in transactions where they have private equity or funds included, rather than just individuals, I would say.
Yeah, absolutely. Particularly if it's already, if the target's already got a private equity backing, they'll have been through that process, at least at some level once before. They're probably more prepared for it this time around.
You'll probably see, I would say, more pressure just because the private equity wants to get out of the deal a bit quicker.
Yes.
And it's opportunity cost after all.
Yeah.
But I agree with you.
Okay, well, I think that's all the questions that I have for you today. Thank you so much for coming on the podcast. I think it was very insightful, and I hope on the other side that you found it insightful too. Make sure you follow up on social media so you can get all the other episodes. And yeah, that's it. I speak to you soon. Thank you. Bye.
Thank you.